All right. Well, hey, Rob, welcome to 2025.
I know, we're finally here.
Yeah. Took long enough.
Yep.
Going through the election last year. Now we have a new president in office. And
Yep.
of course, as we see every day, we have a new economy.
Yeah, it
right?
seems like that.
Constantly. So a lot going on.
Yes.
With, the market's done great, over 25%, 2 years in a row.
Yep.
Now what's going to happen?
Huge. I think that's the question on everyone's mind for sure.
Yeah.
Before we break that down, do you want to just go over what we saw in 2024 and where you kind of think we are now?
Yeah. Obviously, in 2024, we still saw inflation.
Absolutely.
Bouncing around, rearing its head up a little bit. The Fed had to pivot.
Yep.
Right? The Fed was expected to cut interest rates more than what they did.
Yep.
And pull back on that. And then the expectation of 2025, of maybe lowering interest rates by 1%, now maybe 0.5% in 2025.
Absolutely. And equity investors are absolutely looking at the curve and its reaction. And I think that's why you've seen a little bit of volatility.
Yeah. That yield curve, and there's different, points in it, whether, you've got a 1-year treasury, 3-year, 5-year, 10-year, 30-year, all the way across the board. We've had an inverted yield curve for quite a while now. We're going to hit on that in a little more detail here in a little bit.
Yeah.
But that's causing interest rates to remain high.
Yeah.
Right.
Is it actually loosening or tightening things? We're not sure yet.
It's a little rough.
It's a little rough.
Yeah. But if we look at, 2024, all the talking heads out there, every, major news outlet, every advisor in the world has an opinion as to what, was going to happen with the stock market in 2024.
Yeah.
And everyone was low.
Yep.
Right. Now, I know going back 2023, the market was up over 20%. Over 25%. It was a great year. So everyone had thought, well, 2024, it's not going to be as hot a market, but it ended up being a great market overall.
Momentum's a real thing.
Momentum was a great area in the 2024 market.
Driven by some really positive earnings out of technology, and we saw that concentration increase at the top. I can tell you what I'm looking at right now is just the current go-forward valuation, the S&P 500. Currently, next year's earnings were at 23 times. Which is lofty, and we're going to see if that valuation holds. Unfortunately, I think we're, and I know you and I are going to peel this back a little bit more, but we're in one of those times where this could last 5 days, 5 months, 5 years.
It could. So we'll see how those earnings hold up. Hopefully, those companies will continue to produce those strong earnings, and that'll keep the market moving along. And there are, of course, a lot of other factors out there, but earnings is a big piece of it, and they were great the last couple of years.
Yeah, absolutely. And it's interesting, even getting into this earnings season, I think they're still projected to be pretty good this year, anywhere from 10 to 15%.
They are.
So I at 23 times forward earnings, I don't think we're going to get a lot of valuation and multiple expansion, but in a vacuum, showing everything else, we should get a positive bump of 10 or 15%, which would actually be a great year in the markets.
Yeah, I completely agree. So I think we would take that all day long, and I know the clients would also. So we'll see where things take out, or, where they go. Of course, we don't have a crystal ball, and we'll kind of finish up with that today. But fingers crossed. Hopefully, it's a good year in the market.
Absolutely. In fact, interesting statistics on that. So going back over the last 75 years in the market, there have been 3 periods where we've had back-to-back years being up 20% in the S&P 500. You want to take a guess at what our first year or what our first couple years are?
Boy, 1941.
Close. So 1954 to 1955, and the next year markets were pretty flat. I think they're only up a couple of percent. Mm-hmm. This was kind of, I know when you were first starting your career, next time period of interest, 1995 through 1998. We actually had 4 years.
It was a great run.
It was a great run. And in 1999, we were up almost an additional 20%. So now we have this big question mark, what's coming after this year.
What's coming up? I think a great way to look at this, we just finished up last night with the college football playoff. We had Ohio State, great game down to the end, Ohio State versus Notre Dame. If you look at that playoff, we started off with 12 teams. And, everyone's trying to predict, who's going to win, and teams are ranked going into it. You had 1 through 12. Those top 12 teams made it. But right off the bat, number 1 and number 2 were knocked out.
Yep.
Right? Everyone was predicting these are the top 2 teams in the country between Oregon and Georgia, and they were knocked out right at the beginning.
Yep.
Right? It's tough to predict what's going to happen. You ended up with number 5 and actually number 6 those two teams, Notre Dame and Ohio State, playing against each other for the playoff. And so, it's difficult for the broadcasters out there to try to predict who's going to win the national championship, let alone advisors and everyone else trying to predict what is going to happen in the market this year, what's going to happen with interest rates, the economy. There are a lot more factors.
Absolutely.
Right.
Well, do you want to take a whirl and figure out where we're going to be wrong in this podcast going forward? We can do this again next year.
Yeah.
You want to start us off with the Mag 7 and market concentration?
Well, yeah. I mean, the Mag 7, last year produced more than half the rate of return of the S&P 500.
It's unbelievable what they've done.
Right. Yep. Right. Yep.
In fact, you're pretty much spot on. So the Mag 7 was up 50% last year. The rest of the S&P 500 was only up 20%. And right now what we're seeing is, I think, if I remember, we go back 18 months ago, the Mag 7 only comprised a fifth of the market. Now we're up to a third.
Yeah, yeah. And one of the things that we see in portfolios that come in all the time, especially families that are not clients of ours, is that they love, that it's that FOMO. They don't want to miss out on that rate of return. If they're trading and doing things on their own, they heavily get into that Mag 7, right? Well, what's the risk of that, right? At some point, the market's going to pull back. And if you look at, the top 50 stocks that we see out there, in terms of the market cap, they've all had almost all of them, anywhere from a 30 to an 80% pullback in their stock value over the last 20 years at some point.
Absolutely.
That can happen with any stock any day.
Absolutely. And I think people are trying to figure out when that could happen. Might still be a ways away. In fact, some of the portfolio managers that we even talk to have to own those names in order to keep up with their benchmarks, or else you're just not going to do it.
They do.
Yeah,
they do.
Absolutely.
Yeah. And, when you look at the S&P 500 overall, one of the things that we've seen the last 2 years is that only about a fourth of the S&P keeps up with, or has, beat the S&P. The other 3/4 hasn't. And I think what we'll probably see this year is maybe a little more, a greater number of those stocks of the S&P probably keeping up with that benchmark with the S&P. It's probably going to be spread out a little bit more like it was in 2022.
We started seeing that, I think, Q3, Q4, kind of before the December pullback, where it was just technology all over again.
Yep.
Still waiting for this movie to start. Everyone's been anticipating small cap and value to kind of come back. I do think the first couple of weeks of this year, we are seeing some evidence. Even today, small caps are ripping.
They did. They took off
2%.
Yeah.
And I think that's something that's healthy. And if this market's going to continue and keep that valuation at 23, we're going to have to see that.
That's exactly right. We can't keep, riding the same horses.
Yep.
Eventually, they're going to get tired.
Right? Absolutely.
And it's not good for a portfolio to be that concentrated.
Yeah.
You got to have some diversification in there, which we've made some adjustments in the portfolio.
Yep, we have. Definitely plan on going into those later for sure. Yep. Before we go there, do you want to hit on interest rates or fixed income? I know we were talking about the curve a little bit. Lead us off with your thoughts there.
Yeah. What's happened, if we look at interest rates, the Fed dropped interest rates there at the end of the year by 50 basis points, half a point, right? And
very well translated, by the way.
Yes. Yeah. And trying to keep this simple as we go through. But if we look at, why then, because one of the big questions we get asked all the time is, okay, if the Fed is dropping interest rates, then why are interest rates on homes and car loans and all that still going? Why not even just staying even, but they're going up?
Dramatically.
Right. They're going up big time. So why? And there's a number of factors that can play into that, right? But I think one of them is, that the reason the yield curve keeps going up, right, which is the yield on 1-year treasuries, 3-year, 5-year, 10-year, 30-year, all that curve, why does it keep going up? Well, part of that is because, the Fed's dropping rates, but there's such a demand to keep ahead of inflation. People are fearful of inflation. And there's such a demand for those treasuries, I think, to get yield to earn interest, that, that's one of the reasons that it could push that curve up. And there's a number of factors, and we can guess, but I think that's certainly one. And there's certainly more, but, I think that's a strong one to consider, is to, that's a big thing that we get asked all the time. It just doesn't make sense, for most families. Fed drops rates, but yet rates go up. It's because of the demand for those treasuries.
Yeah, I think that's dropping. Well, I shouldn't go that far, but what I will say, what has really surprised me, and I'm looking at it right now. So if we started in October 2024, the yield on the 10-year was below 4. It was at 3.74%. Mm-hmm. Now it's up at 4.65. I think this is your classic smart money versus dumb money. So equity markets versus fixed income markets. And what I would say is, at least what I'm thinking, I think you're getting a lot of fixed income traders and market participants out there that are looking at the amount of debt we're producing and thinking 10 years out, where is this going? And all of a sudden, holding 10-year paper on the United States isn't looking so good.
Yeah. Yeah. You get out past a couple years, the longer you go on that yield curve, I would not want to be out on that branch.
No. More on our market positioning there later. Fixed income in general as well. Anything else market-wise you wanna touch on before moving on?
No, I think and we'll hit on here in a little bit how we've allocated the portfolios, made some adjustments there because of what we're seeing in that yield curve.
Yeah, absolutely. So with it, what are we seeing this year, and how have we adjusted our portfolios? Well, something like Kyle and I, we've talked about this, I think, weekly, if not daily, is just correlations in public asset classes.
That's right.
And this is where we get does the 60-40 portfolio still work?
No.
Questions like that. Well, and let's put it this way, another statistic for you, the 60-40 portfolio, stocks and bonds, the correlation on them is 0.74 right now. It's the highest they've been in the last 3, 4, 5, 6 years or so. And the correlation between the two asset classes, whether they move together or not, it goes positive and negative a bunch, but it's amazing how high that is. And I think that what that means for our clients out there is fixed income broadly as an asset class is not going to shield them from a market downfall.
It's not. We've got some great graphs that we're going to show on this. And I ask families all the time when we look at stocks and bonds, why do you own a bond? The number one answer I get back is, well, Kyle, it's safe, right? No. Bonds fluctuate. We saw that the last couple of years a lot. In 2022 and 2023, where they're correlated, they're moving very closely, very similarly to one another. And so that makes it really difficult in that area to predict what's going to happen in that bond market. And that's where true diversification, which we'll get into a little bit more here as we move along, where you want things that are not correlated to public equities and those bonds on a daily basis.
If you're holding just a standard core bond fund, you've been hit a little bit lately, and you've probably noticed that in your portfolio. So I think what we've done with our last update is we've shortened our interest rate risk. So clients will hear us talk about it as duration, right? And that's just simply a weighted average cash flow metric of when we expect to get our money back on that certain bond holding. We've shortened that up. So now in most of our client portfolios, we're targeting a duration of around 3 or 3.5. And I think when you and I had talked about it, we've already talked about how the Fed controls the front half of the curve by lowering rates or increasing them. Back half of the yield curve is controlled by investors. And really what we're thinking is it's just going to twist. We're going to see the front half of the curve lower just a little bit more, but then the big risk is that back half of the curve really hits up. And we're talking a 10-year that starts yielding above 5, and we just want to shield our clients from that risk of if that happens.
Yeah, that's exactly right. So we're staying in the shorter duration, 3.5 years or less.
Yep.
And that way we can control things better in terms of the risk, the fluctuations that our clients are going to see. And we don't want to see them get whipsawed in those portfolios. And that's what can happen on the back end of that curve. And we want to stay away from it right now.
Yeah. Do you want to move on to concentration risk and what we're doing there?
Yeah. I think a great area that we're excited about that we've really dove into with the client portfolios during those annual strategies is diversifying those portfolios more into private equity, private credit, private infrastructure. I think is a great area that we're really bringing to the table now and adding that piece in. So that gives you true diversification versus, rarely sit down with anyone that needs more Apple stock or NVIDIA stock. What we need is not more, more apples in there. If you've got a bunch of green apples, we don't need more red apples. We don't need to diversify you and across more growth stocks. What we need are actual bananas and oranges. We need true diversification in that portfolio, adding in a piece of private equity, which, talking about private equity and public equity, everyone's used to public equity. Those are the big stocks that we hear about all day long. Private equity, those are the stocks that haven't gone public. When I started in this industry, there were about 8,000 stocks to choose from out there on the Dow and so forth. Now when we look at it, there are only about 4,000. So less stocks to choose from in those portfolios. You think about all the money that gets invested in the market, so much of it just goes into those 4,000 stocks. So now if we can add some companies that are not public and into that portfolio that aren't quite as affected typically by the market, or it takes longer for those companies to be affected, right? So much of the market fluctuations that we see every day is emotional.
Absolutely.
Right? And so when you have those emotional fluctuations in the stock market every day, well, we're concerned about the president doing something or the economy doing something.
Most of the time it has nothing to do with the actual business itself.
That's exactly right. Almost all the time.
Almost all the time.
Yes. And so with that, when you have those private stocks out there, no one's running out to revalue them or drop them by 2, 3, 5% based on whatever the market did in the last month.
No.
So they are a little more insulated from the public equities.
In fact, the managers that we talk to and use in EdgeRock client portfolios here, what they really tell us is, okay, say if we do get into a public market drawdown, call it a correction, maybe even a big correction, bear market where we're down 20%, those private equity holdings arguably should be down 10%, so about half of the public markets. That's
in general.
That's what they tell us.
Yeah.
And frankly, that's what we've seen when looking at the data.
That's exactly right. That's exactly right. And when, one of the things I really like about the private infrastructure funds that we're introducing, when you look at that now, the first time, we started talking about private infrastructure a while back, I thought, well, isn't that roads and bridges? And I have no interest in putting money into roads. Have you seen our roads and bridges?
Ironically, you talk to those managers, they still aren't interested in roads and bridges.
No, they're not. No. They have no interest in it, just like I didn't. But when you look at it and you dig into it, you're looking at cell phone towers. You're looking at water rights, huge demand on that end. You're looking at data, the data centers. There is a tremendous push, tremendous demand on that end. It could be, you look at projects like DIA, where, you're remodeling infrastructure that we need. When you're looking at toll roads, right? I mean, I'd love to have a little piece of E470 out there and get a check every month, right?
You'd be getting some of my money.
Yes, yeah. And I mean, on a monthly basis, that predictable income is very, very nice.
I love the risk return profile of that asset class because these are assets that are going to be used whether we're in a good environment or bad economic environment. So you're going to get something high single digits, low double digit return with a little bit of a yield component on there.
Right.
And that should be pretty close to being annualized.
That's right.
Every single year because these are assets that are always going to get used.
That's right. And when we look at those downturns in the market, so when we go back to, looking at that quick period during COVID, when we go back and look at the 2022 time period here where interest rates really hit us, right? In both stocks and bonds, we saw that correlation and they took a big drop. The infrastructure side held itself really, really well during that time period.
Yes, they did.
And that's what we want is that, when we can take a portion of that portfolio, yes, some of it can get hit during those drops in the market, but we also want some of it that's more insulated from those drops. And what that does, the entire key to investing more than anything else, I 100% agree with Buffett and some of those, more popular investors out there, which is, hey, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Right?
Yep.
Now,
follow closely by keep up purchasing power and then find me a reasonable rate of return.
Yes, exactly, right there. And so with that, we want to do our best to help smooth out those losses so that when the market does take a drop, hopefully we're not down near as much as the market, which in the long run greatly impacts that rate of return, that net effect on a portfolio over time for a family, that is where you really make up ground as a portfolio manager. That's where you and your team really come into play.
I agree. I talk about this a lot, and it's that downside capture in a client portfolio. And I think private markets are going to provide us a great diversifier going forward, where fixed income may or may not be the diversifier that it once was.
Yeah. That area there, it's just how the Fed handles things. They fundamentally changed after the Great Recession, how the Fed and banks handle money, those excess reserves. And because of that's been damaging to the 60-40 portfolio.
Holding rates at zero kind of damage the term premium that you usually get for holding something that's not risk-free, right?
Exactly. So if you look at that, just that right there, what you meant, or what you said there, when the Fed has interest rates at zero, who does that help? The Fed, because now they're not paying interest on our debt.
Equity markets too.
Yeah, and it helps equity markets. Now that helps our clients, right? But when it comes to that quote unquote safe part of the portfolio, the part that's supposed to just yield income, there's nothing there, right? So it hurts families, helps the Fed. Yes, it does help you on the other side, which is the equity side. So that 60-40 portfolio just isn't as attractive. And so now we need to go find yield someplace else, right? So now we're looking at short end of the curve, short treasuries, and we're looking at private equity, private credit infrastructure.
Absolutely. In another area beyond private markets that we've really looked at a lot, derivative overlay strategies. So really what we mean there is let's take your general public equity asset class, but instead of letting it go out there and just riding the markets like in an SPY or IVV, let's throw some options on it. So that way we actually know where our hedges are going to pay off. And we kind of stole the Aptus playbook on that one, and clients are seeing ACIO pop up in a lot of their allocations for a reason. So what we're looking for in an asset like this is, we do want to ride the market, but if something big happens on either tail, we want to be protected by those options.
Yep.
Or at least know what those payoffs are.
That's right. So that ACIO ticker symbol you're going to see in the portfolios in different places, that's going to help offset that and help to hopefully smooth out those returns in those portfolios over time. We're excited about that addition in the portfolio.
Yeah, I also started putting in some D-risk too, which is their core bond where they're going out, and that's the corporate exposure that we've liked. Kyle and I, we've talked about this too. We haven't loved corporate exposure for a while just because we're simply just not getting paid. So you can go out 3 or 4 years on the curve, and the additional amount of yield generated by those issues, I think is only, I don't even think it's 1% right now. So you might as well stay with risk-free, right?
Right.
The government. But knowing the allocators that we are, having some U.S. corporate in portfolios is not necessarily a requirement, but you should have it. And what these guys are doing, again, putting options on either end of indices, right, to try to juice yield and try to protect us from big downdrafts, even in the fixed income markets.
Yep. Yeah. So, I mean, what this comes down to is just a lot of thought by you and your team in terms of how to manage the equity side of the portfolio and how to manage that income producing side of the portfolio to not only get returns, but hopefully insulate the client's portfolios a little bit from the market fluctuations out there when they do happen. And, again, that could happen tomorrow, it could happen a year from now.
Yep, absolutely. So with that, do you want to head into what we're liking for 2025? Any any portfolio themes that you want to hit on or ideas out there?
Yeah, I think the big piece here, when we look at it, I say this all the time, we don't know what the market's going to give us this year. No. And, and I actually had this conversation with a client over the weekend, which was, if you're a sailor on a ship, you don't know what's going to happen out there in the sea. You could have tailwinds or headwinds.
Yep.
And how much control do we have over the sea? Zero, right? Same thing with the market. We can't control the market.
Unless maybe you're Elon Musk. Maybe you figured out something.
We need to give him that challenge. He could come up with something.
That challenge.
Yeah, he could come up with it. But with that, we can't control the market. We can't control the sea. There's always narratives out there that financial firms or different people, talking heads, whatever that may be, throw out. But what we try to do is actually interpret interpret the data, right, and make the best decision that we can,
Yep.
and move forward from there. And so with that, I think the way that we've allocated the portfolios at this point is to be able to capture the upside of the market. If it does continue to move along, if earnings are there, and so forth. So I think we're in a position to be able to do that. But we're also in a position with how we've diversified the portfolio and set it up to where if things get a little rocky, that we're not going to have a one-for-one downside. If the market drops 20%, we shouldn't be down 20%.
Correct.
And and with all that, switching gears for half a second here, and I'd love to get a little bit of your insight on what you think, on the 2025 side and just how we're allocated. But the best rate of return you may have, maybe on the tax side.
Yeah.
And this is where Roth conversions come into play, and the capital gains side, doing direct indexing in a portfolio. That's something that we've been building into portfolios for families individually, one-on-one, over the last couple of years here, which has been a tremendous benefit. Whereas when your portfolio grows, that we're washing out those capital gains through tax loss harvesting, maybe on a monthly basis.
Yep.
And it's been fantastic. The results that we've seen are just A+, I believe, on that end. And so, continuing to, I think for clients moving forward in 2025, what's important?
Yep.
I would look at making sure that, that portfolio is allocated based on what you need as an individual family, right?
Yep.
You and your team watch this on a daily basis, the portfolios, what we should be in, and so forth, right?
Yeah, we always try to match a portfolio allocation with what's the goal of the account.
Yeah, and then with that, we're going to measure how we do over time, and that risk reward, right? Is put into that. So we're looking at, okay, well, what kind of risk are we taking to get that upside of the market? And I think your team has done fantastic in measuring
that.
Yeah, and monitoring that downside risk.
Yeah, so I think after tax returns, which is really what our clients care about. That's always going to remain key. Tax managed SMAs, that's not necessarily new technology, but we're just employing it in a slightly different manage. And yeah, we are incorporating some of those direct indices as well. I think those are a great tool to help wash some of those gains off with aggressively harvesting losses. I think even kind of recapping a little bit, what I think is important for our clients to realize going forward in 2025, yeah, there is that concentration risk at the top, but what they've also probably seen us do, if they've been looking at the trading going on in their portfolios, is us going down the market cap range a little bit. So we're always going to be a little bit wider. We're always going to hold value. We're always going to hold small cap. Those valuations are a little bit better. Hopefully they'll hold up in a sell-off. Who knows if they don't? We see the big risk of correlations going to 1, which means everything, no matter what you're holding, is going to go down. Why I still love diversifying with private markets. And I think our best ideas, much like in the back half of 2024, our best ideas going forward are going to be on the private markets.
Yeah.
I have really high conviction in our managers. I think Makita has done a phenomenal job with Primark. We saw a 19% return last year, which was very public equity-like. Our secondaries manager in Carlisle, they did 14% last year. And secondaries are a little bit of a different animal, but I think long-term providing liquidity to other private equity investors, I think that's a great space to be in. People have heard me say this a lot. When you're a liquidity provider to markets, chances are you're going to do pretty well. Really love some of our real estate plays too with Griffin and S2K. Multifamily kind of depends on where you are specifically, but really attractive returns there as well.
Yeah, I mean, across the board, I think what you and your team have really done a great job on also is to filter out who should we invest in that private space, and manager selection. We've talked about it. We've said this 1,000 times in this office, which is manager selection is critical.
Huge in private markets.
Huge, right? It's incredible. It's like, if I were GM of the Denver Broncos, who you draft and who you pick to be on your team, right? If you can pick the Bo Nixes of the world, right, that's going to lead to success versus, I'm not going to name some of the other quarterbacks that we've gone through. There are too many to name, and it's frustrating. So, manager selection in our world, choosing the right companies, the right investments to be in, that filter that we use as that GM, if you will, to filter it out, is incredibly important. And I think we saw the results of that last year.
Yeah. And in fact, what's the slide that always gets put in front of us? The difference between a top quartile manager versus a bottom quartile. In public markets, it's only going to differ by 1% or 2%. But I think in private markets, it could be double digits.
It could be a 10% swing based on who you choose on that end. So, yeah, that's a big one. And so want to, your team has done a great job. Let's keep at it. And, so I think the themes for 2025 is, having that portfolio allocated, based on what each family, what their needs are and what their wishes are and so forth. We set that up front, and then we manage the portfolio accordingly. And we continue to do that tax planning with Roth conversions and cap gains and so forth. And, and I think one more piece that I would throw out, to families, is we're here to be a resource for things that you do and have going on in your life. Talking to a client last week, he mentioned that his sister was wanting to give her, and his sister's not a client, she's out in a different state, was wanting to give her son $500,000 to buy a house. Well, how amazing is that to be able to do that?
Yep.
Right? I mean, my
Pretty
parents,
powerful.
Yeah. You can make a huge difference there. And we started, and I said, wait. Let's talk through that. Why are we doing that? Not that there's anything wrong with it, and not trying to stop the family from doing it, but let's talk through everything. Does it make sense to finance it? Does it make sense to finance part of that loan? Or maybe you give them all cash, whatever it is. We started talking through it. After a 30-minute conversation, the family decided, hey, the kids are going to finance it instead. We're going to invest this. And we actually ended up, and we weren't trying to get a new client, but we ended up with a new client out of it, right? And my point to that is, we're here to be a resource.
Yep, 100%.
Things pop up in your life like, hey, we want to remodel the kitchen. We're going to take a nice vacation. We want to buy a new car. We want to give the kids a little money. Rather than just executing and making the decision, which you certainly can do, call us.
Yeah.
We're here to be a resource, and we can probably give you some guidance and figure out what's the best math, what's the best way.
Chances are we've seen the movie before and the sequel.
I can quote the movie.
Yeah, exactly.
I've done it all a few thousand times.
Exactly.
I've bought a few houses, but I've helped my clients buy hundreds of houses over the years. I got it down.
Yep.
So we're here to be that resource. Lean on us in 2025. I think that's the big key. Lean on EdgeRock in 2025. We're here to be that resource. And, no matter what is going on out there in the marketplace, we're going to take that data and make the best decision that we can. And we're awake at the wheel every day, 24/7.
Absolutely. And of course, as markets change and develop further, we'll adjust client portfolios across the board accordingly.
Yep.
The good news is we don't like to move a lot. Excessive trading is empirically bad, but we do move when we have to.
That's right. Right.
Yeah.
Let's make those wise decisions.
Any other parting shots before we sign off here?
I think that, I think we covered a good amount here, and hopefully, everyone either, if they've got questions, let us know.
Yeah.
Let us know what topics you want.
Like and subscribe to the channel.
Yeah.
Our marketing director is barking in my ear after that.
Yeah.
Yep.
Yeah. Like and subscribe to the channel, please. We'd love that. And with that, if you have any questions, let us know. Love to know what topics you want to hear down the road. We'll make sure we get those covered or any questions. And let's just, fingers crossed that 2025 is going to be a great year again.
Yeah, hopefully we get to do this again soon. We can dive even deeper into some of the subjects that we brought up today.
Yeah. Sounds great.
That'd be a lot of fun.
All right. Thank you, Rob.
All right. Thank you, Kyle. Ryan, you want to sign us off here?
See you guys.
See you guys. Love it.